Welcome back to Talk Tickers. If you are listening to this, you aren't looking for the headline, you are looking for the edge. We strip away the noise and get straight to the signal.
We try.
I'm your host, and today we are looking at a ticker that is effectively the heartbeat of the North American industrial machine. We are talking about PACCAR. Ticker symbol PCAR.
The giants. Kenworth, Peterbilt, DAF. If you drive on a highway, you see their balance sheet rolling past you every 5 seconds.
You really do.
Okay.
And look, we are breaking down their Q4 2025 print that just dropped on January 27, 2026.
Yeah.
I want to start with a vibe check on the market because the reaction here was, well, let's call it messy.
Messy is putting it politely. It was a bit of a head scratcher for the algorithms.
Right. The stock took a dive pre-market, down about 5%. It clawed back a bit during the session, but still closed down roughly 1% at 120.81.
Mm-hmm.
And here's the conundrum, and this is why I wanted to do this deep dive today. PACCAR delivered a massive revenue beat. I mean, they absolutely crushed the top-line expectation, but the street sold it off. So I have to ask, was this a sell the news event, or did investors spot a crack in the armor that I missed?
It's a classic case of the headline number fighting with the bottom line reality. The market is looking under the hood, and they saw something in the margins that spooked them.
Okay.
Our mission today is to figure out if that margin compression is a structural disaster or just a speed bump. And honestly, I think the market is completely mispricing a strategic shift PACCAR is making regarding tariffs.
Really?
Yeah, there is a competitive moat being dug right now that isn't showing up in the PE ratio yet.
Okay, let's get into the numbers before we get to the strategy. Lay out the print for me. What did we actually see?
So, straight to the bottom line, GAAP EPS came in at $1.06.
Okay.
That is a beat against the consensus of $1.05. Not a blowout on earnings, but a solid beat.
Right.
Where it gets wild is the revenue.
Yeah.
They posted $6.82 billion. The consensus was sitting around $6.05 billion.
Whoa. That is nearly an $800 million beat on the top line.
It's huge.
Okay, hold on. I need to play devil's advocate here immediately. An $800 million beat sounds great, but let's zoom out. Revenue is technically down almost 14% year over year.
It is.
Net income dropped to about $557 million compared to $872 million a year ago. That's a massive haircut on profitability. Why are we treating this like a win?
That is a fair pushback. You're right. The business is smaller today than it was 12 months ago. We are technically in a freight recession, or at least we're climbing out of one.
So it's baked in.
So year-over-year declines are priced in. Everyone knew 2025 was a down year. The reason the stock wobbled wasn't the revenue decline, it was the quality of the revenue they did get.
You're talking about the margins.
The margins, this is where the bears are feasting. Q4 gross margins on Trump parts and other hit 12%. Now, PACCAR is famous for being the Mercedes of trucks. High quality, high margin. The market is used to seeing better efficiency. So when they saw 12%, despite the revenue surprise, the knee-jerk reaction was, wait, have they lost their pricing power? Is the factory floor broken?
12% is definitely thin for them. But looking at the breakdown, it seems like the manufacturing side took the hit, while the other segments were doing the heavy lifting.
That's it.
I was looking at the parts and financial services segments, and they seem to be operating in a totally different reality.
That is the razor and blade model saving the quarter. Selling the truck, the razor, is cyclical. It booms and busts with the economy. But the blades, the parts, that's forever.
Mm-hmm.
PACCAR parts hit a record quarterly revenue of $1.74 billion with pre-tax profits of $415 million. Financial services also hit a record revenue of $569 million.
That is a crucial distinction. The truck sales might be volatile, but the back end, the parts, the financing, is just printing money. It feels like this is becoming a larger percentage of the overall business story.
It is. And structurally, that makes PACCAR less of a boom and bust industrial stock and more of a steady compounder. But we can't ignore the truck manufacturing side because that is still the engine.
Of course. You have to sell the truck to sell the parts.
Exactly.
Right. And that brings us to the most fascinating part of this earnings call. This is the stuff that didn't necessarily make the CNBC headline, but feels like the most important strategic move for the next 2 years.
This is where it gets interesting.
We need to talk about the Section 232 tariffs.
This is the alpha. This is what the casual observer missed because they were too busy staring at the margin compression.
So, set the scene for us. Tariffs kicked in on November 1st, 2025. This is the new trade protectionism reality. How did PACCAR handle this?
CEO Preston Fay was very explicit about this. They executed a strategy they call local for local.
Local for local.
It sounds simple, but the logistics are incredibly complex. It means they build U.S. trucks in the U.S., specifically at their Denton and Chillicothe plants. They build Canadian trucks in Canada at the Sti-Therese plant.
So they aren't crossing borders with finished trucks anymore.
Precisely. They have effectively ring-fenced their production, and that is the moat. Because think about their competitors. Without naming names, many of the other big OEMs rely on complex cross-border supply chains where they build in Mexico and ship to the U.S., or vice versa.
Okay.
Since November 1st, those competitors are getting hit with tariff costs on every single unit that crosses the line. PACCAR is insulated. They are building inside the walls.
That sounds like a massive pricing advantage. If I'm PACCAR, and I don't have to pay a 25% tariff, but my rival does, I can undercut them or just enjoy fat margins.
You'd think so.
But here is the friction management mentioned that the market pricing is currently messy. What does that mean?
It means we are in a game of chicken.
Yeah.
Management noted that competitors haven't passed these costs on to customers yet.
They're eating the cost.
For now. They are likely trying to hold on to market share or working through pre-tariff inventory that was stockpiled before November. So pricing in the market is weird. You have competitors who should be 25% more expensive, but they aren't yet.
But that isn't sustainable. You can't eat a 25% tariff forever.
Exactly. PACCAR expects this to normalize. As 2026 progresses, competitors will be forced to raise prices to protect their own solvency. That is when PACCAR stepped in.
And they hold all the cards.
It's all the cards. They will have two choices. Raise their prices to match and boost margins, or keep prices steady and steal massive market share.
Okay, so they're positioned perfectly.
Mm-hmm.
But getting to this position wasn't free. And this loops back to why the margins were only 12% in Q4.
Yes.
It wasn't because they forgot how to build trucks efficiently.
No, it was self-inflicted tactical pain. We call it the production shuffle. You don't just snap your fingers and say, build the Canadian trucks in Canada.
Right.
They had to aggressively shift production lines, move heavy tooling, and reorganize their entire North American manufacturing footprint in Q4 to achieve that local for local status before the tariffs bit hard.
So that chaos on the factory floor, that's what killed the efficiency.
It was chaotic. They had high overtime costs because they were trying to meet delivery targets while simultaneously dismantling and rebuilding parts of the assembly line. That operational drag is what pulled margins down to 12%. It's a switching cost.
But the heavy lifting is done.
That's the signal CFO Bryce Popolowski gave. He guided Q1 2026 gross margins back up to the 12.5 to 13% range.
There it is.
The expensive shuffle is over. They paid the bill in Q4. Now they're set up to reap the tariff benefits while their competitors are just starting to wake up to the nightmare.
That is a classic short-term, pain for long-term gain scenario. Investors saw the 12% margin and panicked, but they missed that it was a strategic investment to dodge tariffs for the next few years. Now, speaking of regulation driving strategy, we have the tariffs on one side, and on the other, we have the EPA.
The other hammer dropping.
The EPA 2027 standards. We've been hearing about this pre-buy cycle for a while. Basically, the idea that fleets will rush to buy trucks before new rules kick in. Is it actually happening, or is it just a narrative?
It is officially real. The EPA confirmed that the 2027 IOX limit of 35 milligrams starts on January 1st, 2027. There is no delay, no extension.
For the listener who isn't a diesel mechanic, what does that practically mean for the price of a truck?
Management estimates that the new technology required to meet that standard, we're talking new after-treatment systems, more sensitive sensors, higher heat management, will add about $10,000 to the sticker price of a truck.
$10,000 per unit. That is not a small number for a fleet manager operating on 3% margins.
It's massive. But here's the thing, and this is the nuance people miss. It's not just the $10,000. It's the reliability risk.
Good point.
Every time you add complex emissions tech to a diesel engine, you introduce new failure points. Fleet managers are terrified of downtime. A truck sitting in the shop because a sensor failed is a truck that is losing thousands of dollars a day.
So it's behavioral economics.
Oh.
If I know the 2027 trucks are more expensive and potentially more fragile, I'm going to buy everything I can in 2026.
You buy the 2026 model, like your life depends on it. It's cheaper, it uses proven technology, and it doesn't have the new restrictions. This is the pre-buy phenomenon.
And PACCAR is positioning for a rush of orders.
A huge rush throughout 2026 as fleets race to beat that deadline.
And this spills over to the used market too, right? I saw a note that used truck values are up.
They're up 4% year over year. Think about it. If a new truck is about to get significantly more expensive and complex, the value of an existing, slightly older truck goes up. It becomes a substitute good.
It's dumb iron.
It's dumb iron. Simple, reliable, easy to fix. So PACCAR's financial services arm, which finances and leases these used trucks, benefits from asset appreciation.
It's an inflation hedge powered by the EPA.
That is wild.
Yeah.
Okay, so we have the tariff moat, we have the pre-buy cycle kicking in. But I want to pivot to something that wasn't in the headline numbers but stood out in the transcript. Technology.
Ah, yes. The tech company. Multiple.
PACCAR isn't just bending metal anymore. They were talking about agentic AI and data monetization. Is this just buzzword bingo to get the stock price up, or is there actual substance here?
I was skeptical at first, but looking at the R&D spend, 450 to 500 million, there's real substance. They aren't just building trucks, they are building data platforms. They have petabytes of data coming off these connected trucks every day.
Agentic AI is a specific term, though. That implies the AI has agency, it can do things. What does that look like in a Kenworth?
It's predictive maintenance on steroids. Instead of a light coming on saying check engine, the truck's AI analyzes the vibration data, realizes a bearing is about to fail in 500 miles, orders a part itself, and schedules the service appointment at a dealership along the driver's route.
So it minimizes downtime. Exactly. And that is something fleets will pay a subscription for. This is where the Advanced Transportation Solutions division comes in. They are trying to turn that data into recurring revenue.
And if they pull it off,
If they can pull this off, they stop trading like a cyclical industrial and start trading like a software company with a recurring revenue base. That is the long-term bull case.
that's the Analyst Day preview right there.
Yeah.
Okay, let's ground this back in the macro. When you look at PACCAR, a company that touches every part of the economy, what is the signal for the broader market?
PACCAR is a bellwether, and this report confirms the soft landing thesis. Freight isn't falling off a cliff, it's stabilizing.
Right.
If the economy were crashing, PACCAR wouldn't be seeing spot rates pick up in December. They wouldn't be guiding for margins to expand back to 13%.
And for the investor looking at the stock itself, PACCAR has a pretty incredible track record, I think I saw. 87 years.
87 consecutive years of net profit. Think about that. Through World War II, the stagflation of the 70s, the dot-com bubble, the great financial crisis, COVID, 87 years of making money.
Wow.
It is the definition of a sleep well at night stock.
And they pay you to wait.
Dividend yield is sitting near 3%. Total dividends in 2025 were $2.72 per share. So even if the stock chops sideways while we wait for the pre-buy to fully kick in, you are collecting a 3% yield from a company with a fortress balance sheet.
All right, we have covered the earnings, the tariffs, the margins, the regulatory landscape, and the AI pivot. Now, I want to transition to how we actually use this information.
The actionable part.
Exactly. We call this segment, "This is not financial advice."
Right.
Listener, take this seriously. We are just two voices on a podcast. Do your own diligence.
Please.
But expert, if you were sitting in a hedge fund investment committee right now and you had to pitch a trade based on this PACCAR deep dive, maybe something aggressive, what is the pitch?
I've been thinking about this. I call this trade the tariff arbitrage squeeze.
I love the sound of that. Walk me through the setup.
The thesis is simple. The market is severely underestimating the pain that PACCAR's competitors are about to feel from Section 232 tariffs.
Okay.
We are talking about a 25% cost disadvantage for imported trucks that is just starting to bleed into their financials.
So how do you structure the trade? Is it just buying PCAR?
No, you go long PACCAR and short the importers. It's a pairs trade.
Break that down. Why does that work?
Because PACCAR has already paid the switching cost in Q4. We saw it in the 12% margins. Their factories are ready. They are local for local. Their competitors, however, are still scrambling.
It's still tangled up.
They have supply chains tangled across the border. As 2026 progresses, those competitors are going to get hit with either margin compression because they are eating the tariff or volume loss because they raise prices. PACCAR wins either way.
So you're saying they don't just win on product?
They win on political geography. You are betting on PACCAR's supply chain over the others.
That is vicious but logical.
Yeah.
You're longing the protected fortress and shorting the guys stuck out in the rain. Do you have a second one? Maybe something weirder.
Okay, if you want weird, here is the wild alternative. This is a physical arbitrage trade. I call it the golden VIN strategy.
A golden fin.
You go out and you buy physical delivery slots for late 2026 model year Kenworths.
You buy the actual truck.
You buy the slot in the production line. Why? Because on January 1st, 2027, the EPA 2027 standards kick in. The price of a new truck instantly goes up by $10,000 due to the new tech.
And like we said, the new tech is unproven and complex.
Exactly. So a brand new late 2026 model year truck, which is legally exempt from the new rules but has 0 miles on it, effectively becomes an asset that instantly appreciates by $5,000 to $8,000 the moment the ball drops on New Year's Eve.
It's the last of the good old trucks.
It is. It's an asset that is simpler to maintain and cheaper to operate than the 2027 models sitting next to it on the lot. It's an inflation hedge powered entirely by government regulation.
So you hold the slot, take delivery in December, and flip it.
You flip it in January to a fleet desperate to avoid the new complexity.
That is absolutely outrageous. It's basically treating a semi-truck like a limited edition sneaker.
Supply and demand, my friend.
I love it. But again, please do not go out and buy a fleet of semi-trucks based on this conversation unless you have a very large garage.
And a commercial driver's license.
So, bringing it all back home,
Right.
PACCAR Q4 2025. It looked messy on the surface. What is the final takeaway?
The revenue beat was real. The margin compression was temporary and tactical. They took a hit in Q4 to fortify their manufacturing footprint against tariffs.
And that's the key.
That local for local strategy is the hidden gem of this quarter.
And the regulatory winds are at their back.
Between the tariff protection and the EPA pre-buy cycle, the setup for 2026 and 2027 is arguably stronger today than it was 3 months ago, even if the stock price is down slightly.
The headline said miss, but the strategy says moat. That is the signal we were looking for.
Knowledge is profit.
Absolutely. That is all we have time for today on Talk Tickers. We'll be watching that Q1 margin recovery like a hawk. Until then, keep doing your diligence, read the filings, and most importantly,
Keep your eyes on the ticker.
we'll see you next time.